You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey guys, welcome back to another episode of Market Champions. Today we've got Chase Taylor, who is a trader and a macro strategist at Pinecone Macro. Thank you so much for being on the podcast, Chase. It's awesome to have you here.
Yeah, you bet. I greatly appreciate having me on.
Awesome. Chase, I wanted to start off by talking a little bit about your background, how you got into finance, and how you got to where you are today, which is being a trader and a strategist at Pinecone Macro.
Yeah, I definitely did not take the traditional route. I had pretty much completely self-taught, no business school, no Wall Street experience, just fell in love with the markets and just economics, and kind of already loved his history and politics, and that all just naturally turned into me finding macro after stumbling in the dark with some other styles for a while, and just started to blog and do some free research just kind of on the side, and slowly just kind of turned that into the business, and it's been growing and going great the last few years.
What's your background like? So what did you actually do?
Sure. My background is military, actually. I spent a lot of time in the United States Air Force and have done a lot of intelligence work. My academic background is also in intelligence, and I'm currently doing some foresight work, a master's in foresight, which is kind of like training to be a futurist. I find that more useful than the MBA route.
Got it. So, I first wanted to start off, this interview by talking a little bit about what's sort of your macro outlook for, say the next 6, 12, or 24 months. And, where do you see sort of the thing that everyone's talking about, inflation or reflation as they call it. So what's sort of your outlook, for the near future?
Sure. So I think that's getting cloudier and more difficult now. I think 9 months ago this was all pretty easy to see that we were going to have a big acceleration in growth and inflation. Now we're getting to the point where it's getting weird, where it's a lot more difficult to tell where we're going to go from here. The base effects, are starting to roll off for inflation. So I think we've peaked for like CPI, or we're about to in the next month or two. So like sort of the rate of change inflation is going to start getting better, but I think deflationists, so inflationists are going to kind of be frustrated by that, and then deflationists I think could be frustrated by just the underlying level of inflation being a little higher and stickier than we're all used to. So that's going to be, obviously it's going to create a lot of chop in the markets. You look at the bond markets, those aren't going at all, the way inflationists would have viewed. And they've really just gone sideways since kind of mid-February, whereas stuff like oil's, up a good bit, about 20% since then. So I think we're sort of at a weird point where we have to see where a lot of things go. And really what's important is where policy goes moving forward. I think, we got obviously a giant splurge as soon as Biden took over, but that's kind of cooled off lately, and they're really struggling to get anything done on infrastructure, especially anything of any size. And I think fiscal is what's really going to drive, where we go moving forward. So I think growth and inflation will be, they'll finish strong for the rest of the year. Rate of change wise, though, they're going to start slowing down, and there's a decent chance markets start really paying attention to that. Structurally, kind of longer term on the inflation picture, I'm definitely more of we're getting more inflation, that we are in that secular shift that is starting to happen. But, within that, there's still cyclical ups and downs. And I think we're nearing the point where we get that cyclical kind of rate of change peak, and it kind of slows down a little.
What sort of this backdrop in place, what opportunities are you seeing as we look forward?
So right now, pretty much anything attached to energy, I'm bullish on. That includes oil, natural gas, coal, uranium. I'm a bull on all those things, and I have been for really a long time. I see all those bull markets continuing. Same with copper for me personally. I can see that one, getting to the point where it starts slowing down, but near term, I think it's going to keep going higher. Mm-hmm. So those are major opportunities, and another big one for me right now is Europe. That's something my last monthly letter was about Europe. I think, as the U.S. is kind of starting to slow down a little bit, right about the same time as Europe kind of takes off with, put the pandemic finally kind of letting go there, just in time for tourism season, everyone to want to travel. I think there's a lot of tailwinds in Europe that people can capitalize on. You go look at the charts and you see a lot of kind of inflection points, especially, Mediterranean countries, the ones that have kind of been beaten up the most and kind of sort of have the most to gain from a higher euro and, more tourism. So I think there are some great opportunities in Europe, and lately something's starting to perk up as Latin America is catching my eye. Brazil is one I think a lot of people are paying attention to, but if you look at the equity charts of like Colombia, Argentina, it's still early and they're just now starting to kind of tease breakouts, but we're even seeing some movement there.
Got it. Are there any sort of specific sectors that you're interested in Europe, apart from tourism, that is?
So for me, not super sector specific as a macro guy. I just don't get into the weeds too much on those things. As much as I love energy, I'm not a big fan of European energy. Mm-hmm. If you think rates and the currency are going to move higher, and I think they probably will in Europe, then financials should do well. I just usually don't. I just usually don't invest in financials because I'm not a good like single stock kind of analyst guy to begin with, and I especially can't do it with financials because it's all just so opaque. It's one of the reasons I like commodities. It's a very simple game with supply and demand. If you have a napkin and a crayon, you can kind of make a crude model to figure out what's going to happen with supply and demand. Whereas you get into banks' balance sheets and all the policy that touches their bottom line. I just try to avoid those, but just from a macro perspective of, if you think the euro is going to go up and rates across the Eurozone are going to go up, then financials will probably do well. But for me, it's just all about usually buying the country ETFs. So that's what I've done across Europe. Just, actually one that just buys all Europe. And then I've gone out and bought Spain and Italy and Greece and Portugal, like I said, or France actually. I'm also bullish on the UK, but for that, it's just a pound bet for me, just very long the pound.
Got it. And then when you mention Latin America, what is it? Latin South America, what's the bullish case? What's actually going to drive equities and so on higher?
Sure, there's a lot there. I think the biggest thing for me would be my view on the dollar right now is it's gonna head lower. Sure, we'll have some small bounces along the way, but to me it looks like it's about to break and head at least in the mid 80s, if not low 80s. Mm-hmm. And if that happens, it's just a giant tailwind for places like all of Latin America, all the emerging markets in general. But there are some I want to avoid, especially if I'm as an oil bull, I don't want to be long the emerging markets that import a ton of oil. You could look at like a chart of Pakistan, it's kind of breaking out and looking a little bit constructive. But when I look at that, I know how much their oil import bill kind of leans on them whenever it gets expensive. So I'm kind of avoiding that. So if I look at a place like Brazil that, has plenty of oil themselves, okay, they're probably not going to get hurt on that. We're having what looks to be a new kind of structural agricultural bull market. And, Brazil has a lot of agricultural commodities that they export, so they can make a lot of money on oil and agriculture. Brazil itself is hated right now, which is something that gets me excited to look into an idea. So I think there's a lot of drivers there. The biggest one is really FX though.
Got it. And I believe in April you released a report called Coal, the Other Black Coal. So could you talk a little bit about, number one, what are sort of the tailwinds for coal? What's going to drive coal higher? Number two, are there any specific companies that that you want to talk about or that you're bullish on? And overall, what do you see going forward with coal?
Sure. So just to back up a little bit before I talk specifically about coal, something that a way I see the energy market that I don't hear other people talk about, maybe it's just a given and they don't talk about it just because of that, but I sort of see natural gas as a hedge to oil where, if oil gets super expensive or, or the opposite, if oil starts getting really cheap and you start losing production, then you start losing associated production for gas, which makes the gas price go up because there's less supply.
Mm-hmm.
And then, on the flip side, you have coal where if natural gas gets really expensive, then utilities will, especially in America, will start moving over to coal. So it's like sort of like a natural hedge to gas. Gas is a bit of a natural hedge. These aren't perfect, but they do kind of work, a natural hedge to oil. And then I view uranium as sort of a hedge to all of it because, nuclear is a completely different way of getting energy. So what really got me into coal was I own a lot of natural gas, futures and natural gas equities. So if that gets really expensive, obviously I'll make money and that'll be great. But if that gets really expensive, a lot of US utilities will start moving over to coal. And if that happens, obviously that kind of puts a lid on natural gas prices, when that happens, but then coal prices go flying. So I viewed it as just as a great standalone trade because I think that is how that's going to go down. But also kind of a hedge for all the natural gas assets that I already owned. But just in general, coal, I really can't think of anything more hated than coal. So energy's hated to begin with, and coal is like by far the most hated corner of energy, both just from like a normal life standpoint because of climate change and as an investment. Like it's just not something people want to put their capital into. And especially if you're a large allocator, it's just not something you can put capital in with your board or something. So it has like a lot of structural headwinds, but because of that, no one's invested in it. There was a lot of shorts in a lot of the equities recently, which is kind of nice, to see, because if they kind of all run for the exit at the same time, you can get, so it's a big move higher, which we've already seen. But one thing that I found interesting doing the research is I kind of assumed that coal was, starting to wane, starting to go down from how much is being used globally. But it's still the number one source of electricity that we have in the world. And if you just look at the amount that's being used every year, it's basically flat the last few years. But obviously it's exploding in China and Southeast Asia, or has been recently. In Southeast Asia, I think it will continue to move higher in the amount they're using. So, if you look at the next 3 to 5 years, you can't really see a scenario where the amount of coal we're using globally is going to go down. But what you do see is the amount being invested in production and the supply side, that is going down. So it's kind of a natural supply and demand mismatch there. Everyone hates it. No one wants to own it. So to me, it was kind of the perfect trade, especially when I coupled it with natural gas. Plus, you think about coming into this year, to me, it was obvious we're going to have an explosion in U.S. growth and inflation, but also global growth. And you can pretty much chart the price of coal next to global growth, and it's the same chart. It's going to do whatever global growth does. So, I said in that letter, coming into this year, if you're bullish natural gas and global growth, then you were bullish coal whether you knew it or not. So it was kind of a perfect trade to me. And as far as companies go, I never put all my eggs in one basket because I'm just not smart enough to find the one company that's going to get everything right. But I own Peabody, which is a BTU.
Mm-hmm.
New Hope out in Australia is one of my favorites. It's like small, not too many people own it because of China not importing Australian coal. The Australian coal sector is really taking a big hit, which to me is perfect because either they're going to come back and start buying from Australia again, or they'll eventually just move all of their exports to other countries in India or Southeast Asia or even Europe. So I wasn't too concerned with that. To me, that just meant it was on sale even more than it should have been. That's one that not too many people are in or talking about, but it's very cheap. They even own some agricultural and oil assets. another couple CEIX and then HNRG are the two ticker symbols. There's a couple others that I own and like. I think I'm more of I have no problem with coking coal and kind of the steel story because of global growth, but I much prefer the thermal coal side. So I think when you can find a thermal coal kind of pure play, that's a good bet, because if we do get natural gas prices a lot higher, say this coming winter, which I think is a decent chance of that happening, then that's when you get a giant spike in thermal coal demand.
Got it. And when you look at when you have this outlook for sort of the more fossil fuels, so you're bullish on coal is sort of the bad fuel especially when you compare it to something like ESG. So does that make you bearish on, say, ESG and uranium, or are you bullish on uranium as well? So how are you thinking about that?
So yeah, I was actually very long a lot of green stuff coming into this year. I owned what I would just refer to as the green bubble, because it was obviously kind of building a bubble. I own a lot of that stuff for fan, so like the solar and wind, a lot of the big names in that space. But I sold them off. It was probably about 4 or 5 months ago, just because it just got a little too crazy for me, a little too over its skis, just way overvalued. But it's just so obvious that the policy support for it's there. The clamoring for those things are there. So it was a bubble that kind of earned its way into bubble status because of all that. It has a lot of tailwinds. But I'm not necessarily a bear of those things. Like, I don't want to go out and like short those things per se. And as far as uranium itself goes, I'm a huge uranium bull. But I have been since 2016, and it really just started working in the last year. So take what I say with a grain of salt there. But I think that the structural story of just not having enough uranium for the demand that's, in my opinion, definitely headed our way it's one of the most painfully obvious trades I've ever seen. Which in a way is scary, because a lot of times obvious trades just don't work out for whatever reason. But every time I just kind of back out and do the math on how much uranium we're going to need and how much it looks like we're going to have, it just paints a picture of we need a lot higher price for uranium.
And sticking with energy for one more question. On Twitter, someone asked that do you see any advantage to either large ONG producers with major scale, or would you rather select smaller pure play E&P companies that might be able to duck some of the ESG attention?
Yeah, it's a really good question. I think the tail end of that question there is kind of like exactly the reason I do prefer smaller companies. I've owned Exxon and Chevron basically just because they got so cheap I could help myself. But I do prefer smaller companies, and especially for me personally, Canada has really all the best plays I can find are in Canada. Most of them, I should say. There are a couple in the US, but and that's part of the reason, no one's going to come, raiding the boards there and trying to put on, climate activists or anything. If you're a micro cap, oil company, running out of Calgary or something instead of, Exxon, which is just on everyone's radar and everyone's watching. Pretty much all the European majors have already been essentially taken over by people that don't seem to even like fossil fuels. And then now Exxon is who's been really an outspoken advocate, like, hey, we're going to need a lot more oil, so we're going to keep going and getting it. Well, now all of a sudden, like that, kind of the one U.S. company that was pounding the table, like, hey, like, you guys are getting kind of crazy with this. Like, we're going to need a lot more oil, and if we don't go out and get it, that's going to be a bigger problem. And even they, now have two new board members, which might start making some changes. So yeah, I do prefer smaller names, and at least right now, those names are largely in Canada because they're generating an unbelievable amount of free cash flow right now.
Now I wanted to move and talk a little bit about your overall process. So, what's your research process like? How do you actually go about generating ideas to look at?
Yeah, I love this question. And I always love when this is asked of other people, so I can kind of see the way other people, what their process is like. So to me, macro, what it's really about is connecting dots. And in order to connect dots, you have to collect a lot of dots to know which ones to connect. So it's sort of a cliche answer, but reading a lot and reading kind of widely, broadly is really important. So I do that. I read all your like standard, FT, Wall Street Journal, all the normal stuff. Keep up with FinTwit timeline. I have a very streamlined FinTwit like people that I follow. It's under 100, but because of that, I actually like literally keep up with it, and I try to keep very high signal to noise ratio. People that I follow that are only going to kind of post like really informative stuff. So I keep up with that. I keep up with just basic news. I read a lot of other people's research, whether it's investment bank research or other people's independent research. And during my day when I'm doing all that reading, just some stuff just always kind of naturally bubbles to the surface. And when stuff starts to bubble to the surface, it kind of starts to form signals. For me, like trades tend to start out as like really weak signals, and then next thing I know, it's turning into like kind of stronger signals that kind of taps me on the shoulder, tells me to go take a deeper look into something. And then if I go take a deeper look into something, that's where it's going to kind of fail or prove that it warrants me maybe making a trade or thinking about it just that much harder. And for me, technicals are a big part of what I do. One of the biggest signal generators for me is just technicals. Sometimes I haven't read about something, I just notice a chart that's really interesting. So today, notice Colombia is kind of breaking out. Well, I haven't gone out and read much about Colombia yet, but I'm going to. Same with Argentina. Like the last thing I expected was to see Argentina equities doing well, but they are. So I figured it's time for me to go look into that. So it's like a good way to get a heads up. Even if you didn't believe in technical analysis for trade execution, seeing a breakout on a chart tells you maybe you need to go learn about the fundamentals or what's going on the ground there. So yeah, it's just really just a bunch of reading that kind of connects a lot of dots. And that all combines to deep diving on things. And then it's just like yes or a no.
Got it. And when you look at countries like Argentina, do you change the denominator into the US dollar?
Yeah, I think it's always useful to, when you're looking overseas, to look at it in local currency terms, look at it in US dollar terms. And a lot of times I'll look at things in gold terms, like not just, a country ETF or anything, but like anything, I kind of like to look at it against gold. And if you do all three, then you have a good feeling. Like, is this thing breaking out, just in its local currency? Is it breaking out, in dollar terms? And if it's breaking out in kind of all three of those, obviously you're going to run it against, its peers or something as well. But a lot of times if I'm looking at, foreign country ETFs, I'll chart them against the S&P to see how they're doing. With the US kind of outperforming steadily for a decade, if I see something breaking, it's kind of bottomed and breaking out against the US, like that's a big deal to me. So, which has happened in Europe here in the last few weeks. It's starting to break out against the S&P after, getting just clobbered by it for years. Maybe it's a fake move and it just fizzles out in a couple of weeks, but it looks like something to me definitely worth paying attention to at least.
All right. And when you say use technical analysis, do you use it purely to identify breakouts and to set your stop loss? How do you go about using technical analysis?
So for me, technicals are huge, and I use them for basically everything. So everything from information, to like know what I need to look at, but also to identifying where I'm gonna get in and out of a trade. So risk management. So yeah, like you say, stop losses, where I want to buy something, where I want to sell something. So everything from the entry to the exit for me is informed by technicals. But with that said, there's people that do a lot of crazy stuff with charts, and my charts are incredibly simple. I don't have volume up. I don't have, RSI. I don't even use RSI. There's almost nothing you can think of am I using. I'm using mostly what I'm trying to pay attention to is just horizontal lines. So because that's going to represent supply and demand. Mm-hmm. And I do use diagonal lines, but those are a little more informative and a little less, something I want to trade off of as much. Or if I do, I understand that diagonal line is just not as strong as a horizontal line, and I think that's a super important thing to understand personally. But that technical analysis was like a very personal journey for me. I think I tried everything that there is out there, and over the years, just slowly kind of edited and removed things until my process, became what it is today, which is super simple. And same thing for all my research too. Like the amount of things that I used to do that I don't do anymore is just a lot. I have basically, a garbage can full of things I used to read that I don't anymore. And my advice to people getting into the markets now is just go consume everything you can, and then over time you're going to realize the things that have value and the things that don't, and do not hesitate to get rid of the things that don't add value. If you just keep simplifying your process, you'll kind of boil off all the excess, and you'll get down to what you really need.
And how do you actually go about expressing your trades? Do you usually take an outside position, or do you use options? How do you go thinking about that?
For me, I'm pretty delta one guy. I don't use a lot of options. I do sometimes have just a ton of conviction, and I think the options are mispriced. But to be frank, I'm just not good at math, and I don't want another variable. This is something I thought about. It was a famous real estate investor was talking about this. He mostly would go out and buy properties that are already out there. Go buy an apartment building and maybe fix it up and rent it out, and then maybe 20 years later sell it or something. So he's doing great with that. Got rich. Decided I'm a big shot now. I better go be a developer. And then he found out, doing these development projects, all the things that can go wrong in a development project. The timelines can slip. You got to get permits. The weather can affect your building. And I just, as I'm listening to him talk about this, I immediately saw parallels for me personally into options. Like for me, options are like real estate development. It has all these new variables of time and volatility, whereas like for me, I find it hard enough to just get a trade right, just on a binary like yes or no outcome. So if I'm adding in the calendar and volatility, which have sort of nothing to do with why I'm buying something, then it's just making it harder for myself. So usually I'll only buy those buy options if it's just something where I'm like, oh, the market is just completely missing it. So an example is I did buy calls on BTU whenever I got into this coal trade, just because I looked at them, what you can buy, kind of some longer term options deep out of the money, what they were priced at. And it's like, okay, well, those are basically being given to me on a silver platter, so I'm going to take them. But in general, no, I don't use a lot of them. But I trade spot FX, I trade futures and equities. Prefer futures. That's kind of my bread and butter and sweet spot where I like to play, because there's a lot of leverage that I feel like I can manage responsibly.
Got it. And how do you go about thinking about, say, market regime? So, a lot of people pay attention to, what's called the SQN, which is the square root of, the absolute value of moves over the last 100 days or so. So how do you pay attention to market regimes? And if so, how do you think about it?
Not a lot, and not explicitly. I mean, obviously you're going to see it on a price chart, and it's going to kind of come through. When it comes to placing stops, those like ranges are going to, just naturally are going to matter to me. It's a huge part of risk management, I guess, naturally, but it's not something that, if I built a checklist right now for the way I was going to go into trade, it wouldn't be like an item on my checklist, but I think it does naturally seep in to what I'm going to be doing, whether it's entries or exits. And same thing with, a lot of people will use religiously, volume profiles. I'm not even looking at that, but at the end of the day, like it is trickling into what I'm doing, because it's impacting what I'm seeing, in price and sentiment, and what other people are doing.
And how do you think about, sizing positions, and does that purely depend on conviction? And when you have a very high conviction on a trade, you just go all in, or there's people who limit their size to 3% max? How do you think about risk management, and how do you think about sizing your positions?
So thankfully, I'm only trading my own account, which means I can be more aggressive than I would be, I think, if I was managing other people's money. So I have no problem swinging hard if I see a good pitch. So I use a lot of size, a lot of leverage at times, but so you can consider my trading sort of technical with a macro overlay or macro with technical overlay. And at times it's one of those, at times it's a different one. There are times where I'm not paying much attention to technicals at all because I have so much conviction on the just fundamental or macro side. And there's other times where I'll take a trade that I don't even understand the fundamentals of, but the chart looks awesome, so I just take it. But when it's only one of the two, that's when I'm not going to put on a very big position, because I don't have a reason to. I can't be comfortable with it. And on the flip side, if the macro and the technicals are all lining up, the fundamentals, it's just all there for me, that I'm more than willing to put on a very large position. When oil pulled back, and it was 4 or 6 weeks ago, something like that, kind of broke a steep uptrend line. A lot of people freaked out and started getting bearish. It's kind of when the Iranian export news started to trickle out. I just added just unholy amount of oil exposure into that pullback because I had a lot of conviction in the way the chart's still set up, especially if you look at 23, 24, 25 crude futures that are still dirt cheap. Looking into those and a lot of the equities, I was still happy with where the charts were, but just looking at the fundamentals moving forward, I was 100% sure they were going to be great. So I was able to just lean into that and take a really big position, which I've trimmed back a little bit as we started to make new highs. But that's an example where both of those lined up. And then there are times, like I say, I might see a currency move on a chart that it's just a really clean breakout, and I haven't done the homework yet on why it's happening. But let's go by a little bit because the chart looks great. But when I do that, it's a small position because I don't know all the reasons why that's happening yet.
Right. And when you say that, how do you actually go about picking your entries and your exits? Does that also purely depend on technicals and important technical inflection points, or what do you look for?
I would be lying if I said it was always based on that, but I tried to do that as much as I can. Sometimes I just want to be in something, so I'll just get in wherever we're at, because maybe I just now came to this idea and it's already working, and I look at the chart and I'm like, I could wait for a pullback, but sometimes you're not fortunate enough to get that. So then I'll just get in, kind of right where I find it. But what I'd like to do is kind of use horizontal levels where price obviously cares about what's going on at different levels. And personally, I really like to do what I call dimmer switch trading, and instead of light switch trading, where I think what most people seem to do, kind of all in or all out of something. I would prefer dimmer switch, so core position, and then ratchet that up, ratchet that down out of that core position, so where maybe you have 3 to 5 tranches of a position, and you start with 1, and you're willing to go higher and higher, lower and lower. Just kind of keep moving that dimmer switch around. That's the way I prefer to trade, and I use typically horizontal levels to kind of turn up and down that dial, especially if it's going to be a trade that I know I'm going to be in for, say, 6 months plus. Then I'm definitely going to trade that way. And usually, chart's going to inform that. And I'm kind of a religious profit taker, so I will. There's almost always a spot on my chart where I'm going to trim and take some money off the table. And I think a lot of people only view stop loss as risk management, getting out as risk management. But to me, taking profits and where and when and in what size is every bit as much of risk management as just getting stopped out. Because if you let something triple and you never take $1 off, and then it comes back all the way back down and it stops you out and you lost money or you broke even, that's terrible risk management, because you could have locked in a lot of money. At the end of the day, it all impacts your bottom line and where you're compounding. So it's just as important.
Yep. And are there any traits that in particular that you personally learned a lot from, especially about actually trading, trade management, and so on?
I think over the years, it's been like kind of a blend of a lot of people that I've learned from, and just whether it's podcasts or interviews or reading books, but it like kind of all blurs to me. Like I can't think of like one trader that just really stands out. Peter Brandt for me, as far as like a lot of technical stuff, does stand out, and a little bit too on the trade management side. He's very disciplined on just not letting things get into his pocket, which I think helped me. But no single trader I can think of for like kind of the way they operate. I think the style I've built is sort of just taking a little bit from a lot of different people and then customizing that to my own just personality and my own experience of kind of the way markets have treated me is the way I try to adapt to.
Got it. And, for younger traders and more novice traders, how would you what would be your recommendation for them? If you were starting today. So if you were starting today, how would you actually go about learning to be a successful trader?
It's really about, first of all, get out and trade small. Like for me, like I'm not a big paper trader advocate. I think you have to have some money on the line, even if it's if it really is not much money at all. It's just something different about it. So you got to get out and you got to trade, and you have to experiment a lot early on. So you got to figure out who you are as a trader and what it is that works for you. And you just can't figure that out by only like reading and researching and talking to people. You have to skin in the game and be in the game every day. So biggest thing is just get out, trade, just do it. You're going to take some lumps, you're going to lose some money. That's why you have to start small, and really staying small with position sizing, smaller than it feels right, is really the right thing to do. I would argue forever, but at least for the first few years, it's just the easiest way to like kind of blow up, in this game. And trust me, I know, because I've blown up an account in my early days, so I know what that feels like, and it teaches you all the lessons you really need to know. And there's no book where you can read about someone blowing up that teaches you the same as you're doing yourself. And most of the great traders out there, you go read Market Wizards, from back in like the 80s, and almost every guy in that book blew up an account when they were younger. So there's just something about it that it really teaches you tremendous respect for the risk. So that's why you get out and trade. Try to learn that without blowing up an account, but if you got to make it a $3,000, $5,000 account, and not your kid's college money or something.
Got it. Yeah, to wrap up the podcast, what are some risks and some excesses in the market that you see going forward?
Only got the first part. You said risk and what?
Risks and market excesses. Where do you see sort of bubbles forming?
Oh, I mean, they're everywhere right now. It kind of makes it hard to pin them down. I don't see any reason to say like U.S. stocks are in trouble anytime soon. Mm-hmm. And that's just been a giant losing battle, but they're obviously very expensive. So instead of just having a giant long book just sitting on U.S. stocks, for me, I would prefer to play that just with call options, or just kind of in and out of the long side of futures, where if things get bad, like it's not going to be my problem. It's going to get stopped out, quickly. It's one thing that comes to mind. I mean, obviously all this meme stock nonsense, like there's plenty of risk in that. There's definitely risk in cryptocurrencies, even though they've taken a haircut. But I run a small short book within what I do, and I just don't have much going on there, because there's just too many tailwinds overall. And there's too many places to make money on the long side that I'm just not super focused on the risky areas. Short term, I think some of the kind of home improvement stocks, Trex is one of them that build composite decks, stuff like that, where the year over year comps are going to get really bad because they had such a good year last year because everyone was, doing home improvement stuff. Things like that, where this giant splurge of spending is about to slow down, and the comps are a problem. I could see a lot of stuff like that having a rough summer and maybe even, into the fall. It's one area to keep an eye on.
Well, thank you so much for being on the podcast, Shiz. It was awesome having you.
Yeah, pleasure.